I live in a high cost of living area and have seen high appreciation on my primary residence since purchase 6 or 7 years ago. We have over 1.5 million in capital gains accrued on paper, and while my crystal ball is cloudy, I would hope to realize at least 1 million in gains when we sell in 10 or 15 years, if not a lot more than 1 million. Since this is so far above the 250K single and 500K married capital gain tax-free limits at the federal level, wouldn't tax loss harvesting also be useful in this scenario, particularly in a state with a high state income tax or capital gains tax? Thanks.
All right. Well, that's more of an observation than a question. You asked one question there. The answer is yes. If you had capital losses, you could use those to offset your capital gains. So there's a lot of different ways that you can use capital gains, capital losses that come from tax loss harvesting. The first way is you can put $3,000 a year against your ordinary income. The second way is if you have mutual funds that for whatever reason are distributing capital gains to you, a capital gains distribution, that is offset by any capital losses that you have acquired that year or that you've been carrying forward. If you have to sell investment for whatever reason, you want to use a different investment, or you just want to spend the money, or you want to rebalance your portfolio and you find you need to sell something that's appreciated a lot and taxable. That's another great use to have some losses around. If you've got some legacy assets, stuff that you've owned for a long time that has low basis that you really don't want to own anymore, capital losses allow you to change investments without having to pay taxes on that. If you sell a business, if you sell the white coat investor, or if you sell your medical practice, or if you sell some side gig business, then that is a capital gain. And you can use tax losses from your tax loss harvesting to offset that. When you sell a real estate property, including some syndications, funds, et cetera, they distribute some capital gains to you, and you can use capital losses to offset those. In today's day and age, this ability to offset the capital gains on your home is becoming more and more important. It's not just people in the Bay Area and Washington, D.C. and New York that have a high cost of living area. Now, there's a lot of places in the country, thanks to rapid appreciation of housing prices the last couple of years, that are pretty high cost of living areas. I think Salt Lake now is, I think the figure I saw this week was something like $590,000 is the average home now in the Salt Lake Valley, which seems crazy to me. I think it's doubled in the last 3 years. But anytime you have a significant capital gain on a house, you can use tax losses to offset those. Remember, of course, that the first $250,000 in gains is tax-free with your primary residence, but you have to live there for 2 out of every 5 years to get that. It's if you're married, it's doubled, it's $500,000. But above and beyond that, you have to pay capital gains taxes when you sell your house. If you buy a house for $500,000, you sell it for 1.5 20 years later, and you're married, you're going to have a $500,000 in capital gains that you have to pay taxes on. At 20%, that could be a $100,000 tax bill. So if you've got $500,000 in capital losses saved up from tax loss harvesting over the years, that can obviously offset that. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.